Hey there, and welcome to this explainer. If you're tuning in, huge congratulations are probably in order. You successfully navigated the wild real estate market and actually used the home buyer's plan to help buy your very first home. That is a massive accomplishment. But as you're likely discovering right about now, the paperwork didn't exactly magically end at the closing table. Today, we're going to take the often stressful, kind of confusing puzzle of home buyer's plan tax rules and turn the whole shebang into a clear, step-by-step playbook for your wallet. So here's the reality check. You bought the house, you moved all your stuff in, and, well, life naturally moved on. But now tax season has rolled around. And as you're sitting there filing your return, this very specific, slightly intimidating question pops up from the Canada Revenue Agency. Did you make your HBP repayment? If you're staring at your screen wondering exactly what you're supposed to do next, don't worry, you are in the right place. We're going to walk through exactly how to pay your RSP back without stepping into any costly tax traps. Okay, let's just dive right into our agenda for today. We're going to cover 1. The HBP reality, 2. Your repayment timeline, 3 easy steps to repay, and 4 avoiding the tax trap. All right, kicking things off with Section 1, the HBP reality. And spoiler alert, it's a deferral, not a free ride. So the absolutely crucial thing to remember here is that this was never tax-free money. It was a tax deferral. Basically, the home buyer's plan let you take out a massive interest-free loan from yourself up to $60,000 under the newest rules to buy that qualifying home. But because you already got a really nice tax break when you originally contributed that money to your RRSP years ago, the government fully expects that money to go back into your retirement account so it can be taxed properly down the road when you retire. You effectively borrowed from your future to fund your present, right? And the government wants to make absolutely sure your future self still gets paid. Moving right along to Section 2, your repayment timeline. Exactly when does the clock start ticking? Now, your timeline might actually look completely different from your neighbors, and it all depends on exactly when you bought your place. Historically, the HBP gave you a 2-year grace period, meaning if you withdrew before 2022, you start paying it back in the second year after the withdrawal. Simple enough. But, and this is a real game changer, due to some recent temporary government relief, if you made your withdrawal between January 1st, 2022 and December 31st, 2025, you actually get a massive 5-year grace period. That means if you pulled the money out in 2022, your first actual repayment isn't even required until 2027. But listen, regardless of whether you snagged that 2-year or that 5-year grace period, once the clock actually starts, the rules are super rigid. Every single year, you have to repay exactly 1/15 of the total original amount you withdrew. Basically, they give you exactly 15 years to chip away at it and bring that balance back down to 0. To put that into perspective, let's look at the math here. If you totally maxed out the plan and pulled out the full 60 grand, you just divide that by 15. That means you're going to need to prep your wallet for a $4,000 minimum annual repayment. If you took out $30,000, your annual minimum is a flat $2,000. It's a completely predictable, flat requirement every single year for the duration of the loan. Which brings us to Section 3, 3 steps to repay. Consider this your foolproof instruction manual. We've boiled the whole tax code down into a dead simple 3-step playbook for you. Step 1, check your statement. Step 2, contribute the funds. And Step 3, designate the repayment. You're going to want to pull out this exact manual every single tax season for the next 15 years. So let's break down each step so you know exactly what to do. First up, you've got to know your target. And the good news, you don't actually have to guess or crunch the numbers yourself if you don't want to. Every single year, the CRA sends you a home buyer's plan statement of account. This is usually attached right to your notice of assessment after you file your taxes, or sometimes it's sent as a T1028 form. Look for this document. It literally spells out your exact remaining balance and precisely what your minimum required repayment is for the upcoming year. No guesswork required. Step 2 is making the actual deposit. You just need to drop the money into an eligible account, which is usually just your own RRSP, during the tax year or, within those first 60 days of the following year, just like you would with a normal RRSP contribution. Now, here's a fantastic little detail. You absolutely do not have to put the money back into the exact same bank account you withdrew it from. If you found a new RRSP with way better returns at a completely different bank, you can totally deposit it there. But there are some very strict cannots to keep in mind. You cannot deposit it into a spousal RRSP, and you absolutely cannot use a first home savings account, an FHSA, to make your repayment. It has to be your own RRSP. Now, Step 3. Honestly, this is the single most critical part of this entire explainer. Just putting the money into your RRSP, not enough. You absolutely must explicitly tell the CRA that this specific contribution is your HBP repayment. When you or your accountant fill out your tax return, you have to use a form called Schedule 7. You plug the amount of your repayment right onto line 24600. If you're using tax software, there's going to be a specific prompt popping up asking how much of your RRSP contribution you want to assign to the home buyer's plan. Whatever you do not skip this step. And that leads us right into Section 4, avoiding the tax trap, or as I like to call it, the Schedule 7 nightmare. Guys, skipping that last step can turn into an absolute tax nightmare. If you properly designate the repayment, boom, your HPB balance drops, you fulfilled your obligation, and everything is golden. But if you forget to designate it, the CRA simply looks at that deposit and says, oh, a brand new normal RRSP deduction. This means your HPB balance doesn't shrink at all, and the CRA officially considers you to have missed your minimum repayment. And because you missed it, that minimum amount is added straight to your taxable income. And even worse, the RRSP contribution room you just burned on that regular deduction, it's gone forever. So you get taxed, your loan stays the exact same size, and you permanently lose contribution room. It's the worst of all worlds. To be perfectly clear about the fallout here, the CRA does not forgive a missed minimum payment. Whether you just forgot the paperwork or you literally didn't have the cash on hand to make the deposit that year, the result is exactly the same. The unpaid minimum is automatically converted into fully taxable RSSP income on line 12900 of your tax return. It's slapped right onto your income and taxed at your marginal rate for that specific year. As tax professionals often point out, messing this up isn't necessarily life-ruining, but it causes some serious, totally unnecessary tax leakage that really compounds over time. Okay, let's pivot to some good news. What happens if you have a killer year financially and decide to overpay your minimum? Well, it's actually amazing. If you pay more than the required amount, it successfully shrinks your overall loan balance and permanently lowers your minimum required repayments for all the remaining years. So say you owe $4,000 in year 2, but you decide to go ahead and drop a $10,000 repayment instead. Your remaining balance drops so much that your new minimum for year 3 and every year after that shrinks down to just $3,538. Overpaying is an absolutely fantastic way to accelerate your financial freedom. Let's wrap things up with 3 rapid-fire rules that kind of trip people up all the time. First, you have to repay your HBP even if your regular RSP deduction limit is currently sitting at 0. Repayments don't require new contribution room, so you're totally clear there. Second, you cannot claim your HPP repayment as a new tax deduction. Remember, you already got the tax deduction when you first put that money into the RRSP years and years ago. No double dipping. And third, and this is a big one, selling your house does not cancel this debt. The 15-year repayment schedule keeps marching on exactly the same, even if you sell the property. As we wrap up this explainer, I really want to leave you with this one final thought. The Homebuyer's Plan is this incredible tool that helps thousands of people get into their very first home, but at the end of the day, it's a loan from your own future retirement. So keep a close eye on your CRA statements, make your deposits on time, and please, whatever you do, never forget to fill out Schedule 7. You borrowed from your future to fund your present. So are you ready to pay yourself back and keep your long-term wealth intact?